Hi, welcome to Online EdVantage. I'm Professor Gonzalez. The topic today is revenue recognition. This is the first part. We're going to go over the steps of revenue recognition, and we're going to look at recognizing revenue over a period of time and a point in time. So there's 5 steps in revenue recognition. The first step is to identify the contract. So you have a seller and you have a buyer, a customer, and in the contract, you're going to have things like, what is the item being exchanged? Is it a good or a service? What is the terms of payment? Then step 2 is to identify the performance obligation. What is going to be exchanged between the customer and the seller? Is it a good? Is it a service? And then step 3 is to determine the transaction price. Now in accounting we use the word consideration quite often, and it's because the transaction price may not just be cash. There may be a trade of an asset like equipment, there could be a trade of stock or something like that. So we have to take that into consideration for transaction price. We also have to take into consideration time value of money. So if there is a delay between when the customer will be paying the seller, that has to be considered. Step 4 is to allocate the transaction price. If you have multiple performance obligations, maybe the contract calls for a good being exchanged and a service, then the transaction price has to be allocated between those. If there's just one performance obligation, then it's simple. The whole transaction price will be allocated to that one performance obligation. And step 5 is to record it in your accounting records, the revenue. Let's look at when control transfers, because the revenue recognition rule has to do with the control of the good or service being transferred to the customer. So when does it transfer? The customer has an obligation to pay the supplier. So if the customer has to pay, the control has probably transferred. If the customer has legal title to the asset, if the customer has physical possession, that's the easy one, right? The customer actually has the asset. If the customer is assuming all risks and rewards, so if something happens to that asset, they're assuming the risk of it, or if the customer has accepted the service. So if you have a seller and they're giving you some kind of like consulting service and you've accepted it, then the revenue is being recognized. The customer's accepted it, then revenue is being recognized. So going over an example, a customer purchases a printer for $200 at an electronic store, and the printer cost the electronic store $75. Going over those 5 steps, identify the contract. So contracts can be implied. They don't necessarily have to be written. So when a customer comes into a store and purchases a printer off the shelf, then that is an implied contract. Step 2, identify the performance obligation. The seller is giving a printer to the customer. Step 3, determine the price. Well, the price of the printer is $200. Normally in like retail, you know the price, but maybe like a flea market or something, there may be a negotiated price. Step 4, allocate the price. It's just the printer. It's nothing else. So that is the performance obligation. And step 5, recognize the revenue when it is delivered. So when the customer comes into the store and takes the printer off the shelf and walks out the door, revenue is recognized. If it is a company that's shipping the printer to the customer, as soon as it leaves the warehouse, revenue is being recognized. The journal entry for that transaction, for the printer, it was for cash. So we're going to increase cash for the sales price of $200, and we're going to increase the revenue account sales with a credit for $200. And then we have to reduce the inventory account at cost at $75 and move that over to cost of goods sold. Now, if we're looking at a period of time, the criteria for a period of time is the customer consumes the benefit of the seller's work as it is being performed. So example of a period of time would be consulting services, an audit taking place, a company that lends money to customers. The customer controls the asset while it's constructed. That's another criteria. This would be an example of if you have a building and maybe you're getting an addition added onto it, you control it during that period of time. Revenue is recognized over that period. And the asset is being constructed and has no alternative use. Example of this would be if Boeing were making airplanes for the US government, for example. They're making fighter jets. Boeing can't sell those fighter jets to United Airlines. So there's no alternative use. So revenue is being recognized during that period in which they're being built. So if the transaction meets one of the criteria, then we recognize revenue over time in proportion to the amount of the performance obligation. Now, when we only have one performance obligation, it's all going to go to that performance obligation. So looking at another example, it's July 1st, the electronics store sold a 12-month technical support package. So now we're looking over a period of time, over 12 months, that the customer is going to be consuming this support package. And it's for $300 cash. Prepare the journal entry on July 1st. So once the customer's paying for the technical support, the company, the seller, will be increasing cash with the debit for $300. And because nothing has actually happened, they haven't actually started performing the obligation, then we're going to put it into a liability account called deferred revenue. Now, many times the liability account could be called unearned revenue. You may have heard that before, but really the same thing, just a different name for the same account. Then as time passes, we'll start recognizing the revenue. We'll take the 300, divide it by the 12-month period in which the technical support is going to be taking place to get $25. And then each month, we will recognize $25 and take it out of the liability account. We'll reduce the liability account deferred revenue by 25 on July 31st. 1 month has passed, so we're reducing the liability, and then we're going to put the $25 into service revenue as we're recognizing it. And this journal entry would take place every month for the 12 months. So in summary, there are 5 steps to revenue recognition. And sometimes they're very complicated. Revenue recognition can be very complicated, so you want to go through those 5 steps. We recognize revenue at a point in time, and we recognize revenue over a period of time. Thank you very much. I hope you found this video helpful.